All right, guys, well, we're going to go ahead and get started. I'm going to turn things over to our first speaker, John Seville. We appreciate you being here, John. John's going to take the first hour of education. He'll be followed by Hubert, who will then be followed by Andrew Keene. So John is going to talk about profitable trades and targets and some of his setup. So I'll go ahead and turn it over to you. Thank you.
Thanks so much, Morgan. And yeah, good morning, good evening to everybody, depending on where in the world you are. I see we have some fellow Australians in the group. And thanks so much, Morgan, for organising such a wonderful event. We do have such a great list of speakers, each of whom I know personally. They're great guys. It should be a wonderful event today for all of you. We're going to start off, of course, with myself, where we talk about profitable trades and targets, and most specifically relating to stocks. But you'll see that what we actually cover today is going to be applicable to a lot of other trading styles, especially with options. So even if you are a more advanced option trader, stick around, you'll get some great stuff here. Just a quick disclaimer up on the screen, just as with any financial products. Basically, while we will discuss some live market conditions today, obviously it's not a recommendation to buy and sell. So a quick introduction to Acorn. Acorn was started back in 2007, for those of you who don't know us. We were started by a small group of technical analysts, including myself. And of course, we focus mostly on the technical side of the market. And it couldn't have been a better time to start doing that, because using some of the techniques that I'm going to be teaching you about today, there were some big red flags that indicated that smart money was pulling out of the market. And this was about the time we were starting our educational company, and we went around and saying, look, there's some big problems here, and here they are, and we would be getting out of everything in June 6, 2008, and of course we all know what happened after that. So that was basically what formed the foundation of what we do. Now, to bring us forward to 2014, we want to ask ourselves some key questions now of where we're at today. And as probably all of you have been seeing, this last 2 weeks, in my opinion, have been very pivotal. With some very important times, because of course, leading up till now, we've had central banks pumping money into the economy with no end in sight. We've had a huge rally in the market. I think we entered into 2014 at all-time highs of bullish sentiment. One article I was reading from StockTwits, which of course is the social media stock tweeting website. They are over 96% of the traders in StockTwits had strong bullish sentiment going into 2014, and that alone scared the hell out of me. Optimism among all the market players, so all the IPOs coming out, things like that. Just a lot of very, very bullish, overbought scenarios. The big leaders, of course, were all the cloud computing and technologies were the market leaders. But more recently, perhaps what's on the tip of everyone's tongue recently has been that the darling investment of the emerging markets has been crumbling. The Shanghai, big problems there. The Bovespa, big problems there. We'll talk about that a little bit later when we get into some of the live market condition analysis. But what is your plan going to be as these problems arise and the Fed continues its tapering? And more importantly, then, what did we actually learn from this happening before back in 2008? What changes have we made, or what are we going to do? So I always like to start out the groups with this question: what type of investors are you? Do we have a bunch of day traders here, swing traders, or long-term investors? What's most people targeting in their investment strategy? All three? Okay. Swing trading. I'm looking to swing. A lot of day trading. Beautiful. So a lot of big majority in swing trading and day trading, which is great, because basically what we're going to be talking about is a technique that you can be using on any time frame. But the day trading and the swing trading is particularly good with this. Now, of course, the next question to always consider when you're developing that strategy is what your investment objectives are, and you know, these are the same kind of cliches that you get with any kind of financial objective. You know, we're looking for more money, more time, toys, you know, all the kind of cliche images. But it's often important later as well. But if your main objective is going to be spending more time with the kids, day trading might not be the best thing. Whereas, you know, if you're looking more for travel, swing trading seems to be an appealing factor. So it's not always just about money. Sometimes it's also about time and other things it provides. But finally, and perhaps the most important of all, how do you currently make your decisions? So I'm assuming we have a pretty informed group just by the fact that everyone's here today. But how do most people here make their decisions? Is it a coin toss? Thanks, Gary. Is it news? Is it tips from friends and brokers? Is it things you're familiar with? This would be a picture of Vancouver, of course. I'm sitting right here at the moment. Monkey throwing darts. Yeah, so most people's decision-making processes are sometimes a combination of all of those. And the more advanced we get, the more hopefully we're looking towards charts as well as an important factor. But no matter what we base our decisions on, what I commonly see throughout all the people I've worked with over the years is that there are common emotional traits to what gets us off track. So these are failing to limit losses, averaging down, buying into emotion, believing in public information, and selling on pullbacks as some of just the most common. And even if we are very well informed in terms of what we're looking for on charts, so often I hear the horror stories where people call in and say, John, I picked this stock, I thought it was going to go soaring up, and after it was up 10%, I felt it would go another 10%, so I held on to it, and it gapped down 20. So often, even if we have good, solid ideas, it's really easy to get off track with these types of distractions, unless we have rigid rules and targets in place that we put in place for strong reasons. We'll get into that. And that's perhaps why I think most people lose money. It's not because they don't have good strategies. It's not because they don't have good ideas, or they don't understand the idea of being too greedy and too fearful. But it's very, very difficult to harness consistency and to turn good ideas into consistent money unless we have a strategic way of consistently going about it. But it's not surprising when this is what we wake up to every day, is the constant barrage of noise, things to take us off that track, to scare us out of a position or entice us into one we shouldn't take. So let's start getting into kind of more the tangibles that we can actually put down on paper. So again, let's go back to kind of a lot of the answers here: Fibonacci's, candlesticks, price action. If those are the ways that we are making our decision-making process, what would... So if you were to take a pen and paper, or in this case a crayon, and I asked you to draw exactly what the chart would look like when you would buy it, what would those candlesticks look like? What would the volume be? Over what time frame would it be? And if it's a trend line, what type of trend line? What would the indicators then be if you want to look to those to confirm it? What would the sector be? Is there a process or a list of ingredients that you go through? And I use this example when I'm talking about this in class. When you go out there and if you were to go buy a new car or a house, let's say you're out looking for a house for your new family. You've got 2 kids and a wife, and you've got a budget of $500,000, and you go out and you start shopping around, and you've got this list of things that you need: 2 bedrooms, air conditioning because it's freezing cold in the winter and too hot in the summer, like sometimes here in Vancouver. You know, you don't go out and purchase a 1-bedroom bachelor pad condo. Not if you want your marriage to last anyway. So in general, when we go out and we shop for things of importance in our life, we do know exactly what we're looking for. We know what criteria it has to have. We know how much we're willing to pay for it. And if we go looking and we don't find that, we keep looking. But in the stock market, I find it's very rare to find people that have that rigidity in knowing exactly what those things are. And that's what I'd like you to help start posing some ideas as to how we may begin to build that list, because it can be immensely valuable. So how do we write down those lists of conditions? And the key thing is, if we don't have those, the old saying is, if you don't know where you're going, then any road will take you there. So how do we start building this checklist? Well, the way we started years ago is we started looking at it from an engineering standpoint. Let's reverse engineer the market. Let's figure out what really drives it. So the first question we ask is, okay, who controls the market? Any guesses? Who controls the market? Volume. Big money, thank you. We all do. Funds, buyers and sellers, high frequency traders, exactly, Pablo. So ultimately, volume dictates price. I just want to make sure, I think that someone was saying we're having a bit of, having me cutting in and out. Can everybody hear me okay still? Anyone having audio issues? Okay. Okay. Looks like it's. You may want to try to just reconnect if you're having issues, but looks like most people are hearing loud and clear. And yes, my strange accent isn't a technical audio problem. I was just born that way. So yeah, so let's talk about this. So volume ultimately dictates price, and volume is going to be the key thing in understanding the true value of price. We'll come back to that. But if volume dictates price, the next question we want to ask is who dictates volume? And you've all said that the big money, the hedge funds, they dictate the price. In fact, they estimate that 70% of all of the volume in the stock market comes from high frequency trading or algorithmic traders. And this is basically meaning 7 or 8 out of 10 stocks that are bought and sold happen from a computer deciding to buy it or sell it based on rule systems or preset algorithmic functions. So again, someone says, okay, well, does that, John, mean that these algorithms have 80% of the money? No, they don't. But what they do is they have control of the volume. So if there's a example in a room, each with $1,000, and they all go out and buy and hold a particular stock. Okay, so if 100 people with $1,000 go and buy a stock today, how much volume do they account for in dollar value? At 100 people with $1,000, how much volume do they account for? Be 100,000, wouldn't it? Now, if as a trader, let's say trader Joe Bloggs comes along and he's got $1,000 as well, and he buys the same stock, but instead of buying it and holding it, he buys it and sells it. Well, now he takes account for 2,000 volume. And let's say that they do that 100 times in the day. Well, how much volume does that trader now account for? They'd account for 200,000 volume. So with $1,000, a high-frequency trader could account for 200% more than 100 people with the same amount of money. And this is how if you've ever wondered how they're able to have such massive levels of influence, it's because they can do this type of death by 1,000 cuts. So, and that's how they make billions of dollars. So wouldn't it seem to make sense that we'd want to know how they make these decisions? Because these forces are so strong that they can cause a market, such as in May 2010, to crash 1,000 points only to come hitting some magical floor and bounce right back the other way in seconds. I mean, that's billions and billions of dollars. And I'm sure we are all familiar with this phenomena that happened back then, just as most recently the NASDAQ got shut down because someone apparently tripped over a power cord, which I find a little bit hard to believe. Of course, the high-frequency trading firms getting shut down because they're losing hundreds of millions of dollars in half an hour. This is the type of thing that's going on, and I guess the value that I'm trying to point out here is that these forces are not only what ultimately changes the direction of stocks and indexes, but they're doing it using rule sets that they're following the same rules millions and millions of times over and over again. And when something does the same thing again and again and again and again, you can reverse engineer it. So when you start looking at the stock market, and I'm trying to lead you through the thought process of how we came to our, when you start to look at the stock market, most people think it's chaotic. How could you see the same thing happening again and again? It's doing all these different other things. But the trick is that you want to look at it as basically a blend of lots of different plays, all kind of put onto that one chart. So I liken it to a football game. When you watch a game of football, we've got the Super Bowl coming up this weekend, I believe. And when you start looking at two teams playing against each other, to me, first looking at a game like that, I saw chaos as well. I saw, guys running across the field with no particular order or direction at each other, balls being flying to different people across the field. It looked very hard to follow. But the more and more I got used to watching American football, the more I realized that they were very exact strategies that the other team was executing. But they kept changing that play to keep the other team on their toes. So in the stock market, I'd liken it to that. You've basically got the market makers, smart money, the coaches on the other side of the field, and they're trying to basically execute plays, execute rule-based formations to move a stock in. And the trick is, if we can figure out what that play is and where exactly it dictates a stock will move, we can make some money out of it. We can make great money out of it. And that's where we build the strategy from. So let's get into the nitty-gritty. The first step, if we want to start picking out some of these formations, is to understand firstly some core values of what moves the market, a true statement, if you will. Understand when we look at the market is that the stock or index will generally never change direction unless it has hit one of these following few things: horizontal support and resistance, trend line resistance, or moving averages. It has to, I generally believe that it has to hit one of these three things in order to change direction. So in other words, the algorithms don't see this. They see this. They see levels. And the trick as a trader, and I know this sounds like almost oversimplifying it, but really the trick in a simple way of making consistent money in the market is to know where these levels are. If we can identify where these levels are with accuracy, then the way to make money and a simple strategy is simply to buy as soon as the stock comes down and hits one of these levels and sell it before it hits the next one. Because if we can assume it won't change direction until it hits the next level, then we simply buy when we hit support and sell before we hit resistance. as long as we can know where those levels are. That's the grid. So you go back to the flash crash of May 2010, you can see some of these levels now drawn in. This was a fairly easily identifiable support level where the stock has came down, the index has came down and bounced directly off it. If you could just imagine how valuable it would have been to know to load up on every stock with a ticker symbol right around 1060. How valuable would that have been? The key thing is that every stock has levels like this. So the first step is to find where the strongest levels are. So as the stock drops, there could be all these different places following that previous strategy that I mentioned that we could potentially buy. But where we want to buy is where the highest probability is that it will bounce with strength and conviction. So as we look at these levels, we have to ask ourselves, well, how would we know what the strongest level was? And the way we want to do that, I'm just going to grab my pen out here. The way we want to do that is we want to look for a point where the market comes down and bounces strongly. So my pen isn't working on this screen, so I'll just bring up our good old-fashioned friend. Let's use this whiteboard here for a second. So when we've got these levels across the screen, the trick is we want to find something that is a strong reactive level. So think back to reverse engineering. We want to see that the stock has bounced strongly off of this level before. So as we come down, we want to see a sharp reversal off of the support. Because that means that the algorithms have reacted violently. They don't take time to make decisions. Algorithms think in ones and zeros. So when we see a sharp, strong reaction, this is the first signal that we have algorithmic buying. The second is to look for volume. So we want to see a sharp, strong reaction. So we want to be asking ourselves, how quickly did it drop to this level? Secondly, how quickly could it turn around from this level? And then how much did it go up from this level? The next thing that we want to ask ourselves is how fresh is it? Now, when I say fresh, I don't mean whether it hit it yesterday or a day before. What I mean is how many times has this level been used? So as we come back down, how many times do you think, if I just throw the question out to the audience, in general, do you think that you're looking for more touches of the support line, the better, or less? So if you're looking at a stock and you see that the stock has hit $10 5 different times and kept bouncing, is that better? Or do you want it to have only seen it bounce once? More or less. Now, when I first started trading, I started trading 13 years ago now. My guess was the same as many people's here. I thought the more the better. I thought, well, gee, if the stock's bounced off $10, 8, 9, 10 different times and kept going up, wouldn't that mean logically that that level was really strong? And thank you, Brian and Mr. Murphy. The more bounces we've actually had, the worse. Just go back to that football example. If I'm a football coach and I played a Hail Mary every single play, don't you think that the other team's going to suddenly realize what's going on? And the job of the market, like your opposition coach, is to make money from you. The market isn't a charity. For someone to win, someone else has to lose. So the job of the market maker, the big money, is to play out these patterns, but as soon as they become obvious, that's when they stop working. So when we start to see a pattern, as some of you said, the best possible bounce would be the first one. If you can figure out where that stock is likely to bounce the first time, this is going to be the strongest. The next strongest is going to be the second bounce. And ideally, that's where we're going to find the majority of our trades. As soon as it's actually hit a third time, that's the very last time I would ever trade a stock, whether I'm looking for an option play on it or a stock play on it. Because after 3 times, this is generally when the stock stops working. So I call this the rule of 3. And if you actually now go start applying this to a lot of common charting systems, such as your ascending triangle, or a rising wedge formation, what you'll start noticing is that after 3 touches, this is generally when you get the break to the upside or downside, depending on the type of pattern you're trading. So let's go back to the chart, and I'm going to bring up some live examples here once we've covered the these basics. So I'd like to throw the question out to you. If we have these 4 possible trading opportunities, so we're looking at a chart right now, and we say, okay, there's 4 places we could possibly trade this, based off the simplistic strategy of simply buying or selling resistance. So Laurie, the strongest play would be the first one, although it's the hardest to find because you have nothing to go off. The second would be the most common and strongest to play for most traders. So let's talk about this. We're looking for an opportunity to make money on this stock. So we've got 4 things we could do. We could wait for this stock to go to the bottom and buy at A. Let's call this A. Or we could buy this here at B. Or we could short the stock here at C. Or we could wait for it to go right up to the top again and short it at D. Which do you think would be the best possible trade? A, B, C, or D, going from bottom to top. Yep. So I would have said, and being just interesting, this is a great question to ask because there's never the same answer. People always have the difference of opinions, which is what makes the stock market great. But yes, I would say A. The reason why I would say A, and if you said B or C, why don't you give me a good reason there in the chart, because there's no such thing as a wrong opinion. But what I would do, the reason I would pick A, is because A has been only hit once, which means the next touch on that is still fresh, it's still strong. Whereas if you look at here at level B, it's already been hit 1, 2, this will be the 3rd time, so it's not as strong as A. The second thing, if we want to just compare A and B, is when A was, when we rallied down to A, it went straight up 1, 2, 3 levels. And remember, the big money, if it's going to load up with tens of millions or hundreds of millions of dollars, it can't do it in a second and sell the very next second. It has to accumulate in, and it has to go up enough that they can have time to sell off to other people. So A has the strongest move, going up 1, 2, 3 levels, whereas B, only 1. If we were to look at the next best trade, it would be D, because D also is fresh, only hit once, and the only difference between the two is it dropped 2 levels versus going up 3. So this gives us a decision-making process of being able to analyze, okay, if we're going to buy a trend line or a support line or what have you, how do we assess its strength? And the stronger it is, the more probable. So next quick quiz. If we look at this, if we look at A and B here, and we were to short a stock, now we're looking at two charts on the same day. And by the way, this could be a daily time frame, an hourly time frame, a 5-minute time frame. Price action doesn't consider time; it just considers prices. It's just, but the smaller the time frame you get, the more different charts you find inside it. Kind of like opening up a Russian doll. Every time you open up that Russian doll, it's just a smaller one, exactly the same. So let's just pretend this is a chart of any time frame, and we're looking to short one of these companies. Which would we pick? Which would be the highest probability short? Exactly. It would be B. That's right, because you have the sharp drop versus this kind of gradual drop. This is retail. This is the smart money. This is the big boys. Not only that, but A also has a higher low, showing that buyers are getting into it, whereas B has a lower low as compared to A. So two strong reasons why. In fact, on a scale of 1 to 100, 1 being excellent, and 100 being very bad in terms of how you rank the strategy's performance, A is over 60 in terms of the success, the probability of a profit shorting that, versus B is in the top 20. So what we want to do, just to go back, we want to, when we go to see if we got smart money there, we want to ask, let's start there, we want to look for previous strong levels of buying. So we want to see strong level dictated by how quick did it go down, how quick did it turn and go back up, and how far did it go back up. We want fresh levels. So no more than the maximum would be 3 times. This would be, the third time would be the very last I'd even consider. Better to look for the second, or if you can, if you're advanced enough, look for the first. And then powerful levels. We want to see the opportunity that it's gone up 20-30% maybe, and we can tag along for the first 10% of that ride, not get greedy. Once we've got that checklist, we've got a little bit far. Once we've got that checklist, we then want to look for other things. We then want to look for ideas. So we want to then correlate our trades with the market direction. So is the S&P bullish or bearish? And not by looking at how much it's gone up or down in the last week, but bullish or bearish because is it at support or is it at resistance? That's what's really going to tell us, is it bullish or bearish? Same thing with the sectors. If we're then going to look for a bearish, if we feel that the market is bearish, and we've been calling this market to drop since January 1st, so we've been looking for bearish positions almost all year. But let's say you take that and say, okay, we feel the market's bearish. Now we're going to look for a bearish sector. Well, again, don't look for what the strongest or weakest sector has been. You want to look for what's going to be the strongest or weakest sector by looking at your sectors, the spiders, and graphing them just like you would a stock and saying, is the stock in a bullish pattern or a bearish pattern? And what's it likely to do next? And that's how you find the sector to correlate. I'm going to be showing you how to do this in a moment with some looking at the emerging markets and financial companies, some of the recent picks we've had. But once you've got all this in place, you then record it into a spreadsheet. You record it into a spreadsheet, and then you want to have everything going across from left to right. You want to have it all basically graphed out. So once we've found this, another final checklist here. You want to see that in order for the market to change direction, the smart money has to agree. And this is why this is so important. And yes, this is being recorded, Doug. So if we have an idea and we think this company is the best thing since sliced bread, we must remember that unless the smart money agrees, it won't do what we expect it to. So no matter how much research we do, the market must agree. And that's why we look for this fingerprint that I've been showing you. So here's an example, just an older one, CBOE Holdings, Chicago Board Options Exchange. You can see the stock rallied right up into a strong level. So Bob, this is powerful because you can see that the Chicago Board Options Exchange, a major, a heavily traded stock, CBOE, went right and then went straight down in one day. So what was previously a powerful system in the way up was basically turned on its heels and shot straight down. It then hit that same high and went down again. So when we were looking at this coming up to the same level, this immediately was something that had met those criteria of a strong, powerful zone that was highly probable that it would drop from. As you can see, what happened next, we had a nice big pullback all the way down from $30 back down to the same level. And we sold at around 28 and 28.50 were the 2 points we, this was actually in fact an options trade. We bought puts on this. And then took that gain from here, not gambling how far it would go down. So once you've got that, once you've been able to graph your chart up properly, now we look to confirm. So look for the indicators, overbought, oversold. If we're looking at an oscillating trade, something we expect to reverse, we look at oscillating indicators, look at Bollinger Band, look for it to be out so that it's probable it will pull back. We can look for CCI, we can look for RSI. Now on the flip side, if we're looking for momentum, we might be looking at stochastics, we might be looking at moving averages, we might be looking at RSI in a different way. But knowing what type of trade you have is then going to dictate how you confirm with the indicators. And finally, we then want to consider the probability that of what the chart is on the stock. So we want to consider what type of pattern we're dealing with and what the probability is of it going up or down and how far up or down. So, audience, who is really comfortable in drawing on their trend lines? Who's really quite comfortable with identifying chart patterns and drawing the trend lines, and who feels they need a bit more work at it? Because there are some steadfast rules that you can use. Okay, so I'll show you this in a live example. It looks like some people could use some help with it. So the number one trick that you always want to use is always draw left to right. And I'll show you that here in a minute. And so once we've got all of this connected well, our final checkpoint, and one of the most important, is where is the smart money going? So we've identified smart money buy and sell zones, but the final thing we want to do that will edge ahead of everyone else. And look, I've worked with traders that have got 1 year of experience. I work with traders that've got 10, 15, 20 years experience. And when you put all of this together, it's very, very powerful. Smart money direction, smart money sentiment. So I told you at the beginning that we talk about price and volume and its role versus one another. What do you define, everybody, as an uptrend? How do you define an uptrend? When you're looking at a stock and you say, is this uptrending or downtrending, what do you look for? Higher highs and higher lows. Sure, that is the technical definition of an uptrend. However, volume is very important, because what if I ran a lemonade stand and I sold 100 lemonades today for $1? I make $100. Tomorrow, I decide to double my prices for $2 and I sell 30. Now I've made $60. And then on the third day, I double them again to $4, and I only sell one. Well, price would be increasing, wouldn't it? Price would be increasing, the higher highs and higher lows increasing, but the amount of money that the business is making is significantly less. Because what's happening is the volume is decreasing as price goes up. So if we want to get a true uptrend that actually defines that the smart money is buying, we actually need three things. We need higher highs and higher lows, and we need higher volume. And the third and final thing we also need is we want the stock to consistently be closing in the top half of its range. And that is a true uptrend. So let's now break across and have a look at some real stocks that we picked out using this kind of everything we just talked about put together. Okay, so have you got the chart up? Can everyone see that? Excellent. Oh, I see lots of familiar names popping in here. Hello, everybody. Okay, so let's talk about how we do this. So I'm going to start with something. Zoom. Let me just get all these lines off. Let's start with the beginning. So I'll just go through this quickly to show you how I would approach this chart. So I sat here with a student actually in my office on Friday, and they said, "Well, John, I don't understand why it's relevant to go back when we're day trading, when we're picking day trades and we're picking trades that last for 3 days, maybe a week. Why is it important to go back 6 months to draw the trend lines on there?" And I said, well, it's important because we don't know what we're dealing with on the right unless we know what's relevant on the left. Who's had that problem? Who's ever had the problem where they don't know where one pattern starts and another ends and another begins? Where they don't know whether they should be connecting this line and this line or what have you. Yeah, common problem. Most people just don't know where to start and where the next line begins. So the trick is to go back long enough that you weed out that decision-making process. So I'm going to start right at the left here and go in. And the trick is to go left to right. Don't go right to left and connect what you want to what's on the left. You start on the left as if you couldn't see the right and just begin connecting the lows. So let's not even look forward. Let's go back. So we connected our lows. Now we've connected our highs. And what we see is an expanding range, which indicates bullish activity. That's what that pattern means. As if the range expands, the bulls are getting stronger. Now, what happens is we'll go back to our statement earlier. What did we say? We say we do not expect the stock to ever change direction unless it hits something. Well, this is a problem now because there's a bunch of lows here that didn't come all the way down to this trend line, but they did change direction. So now we know we need to connect the bottoms. One bottom, two bottom, projected to the third. We can now also do this for our peaks. Now, if we now look, again, instead of trying to look at a chart and figure it out, just follow the rules of drawing the trend lines on properly, and the chart will tell you what it's doing. Because now I see that I've created a contracting range. And just like this is bullish, this is bear. This is bullish. This is also bullish. When the sellers are contracting, it means that they are weakening in strength. So we're expecting now a bullish breakout. And there we go. There we get it. You can see now that we've got the lows have now bounced off something else. So we now throw that line in also. And this is where one trend ends and another begins. This trend has now been broken as of this day, right here. So now we have a trade. Where would I be buying this? I'd be buying this right here at support because we know this is our new level. And I know where's the next problem? The next problem is here at 31.32. So we can get in at 28, out at 32, would have actually popped up higher than that, and that would be it. I'd be out, we pick up a nice 10, 15%, even 20% actually, and we move on for our next trade. So now we're looking for the next level. Aha, lows. As remember, go back to our rule, it has to be hitting something. It keeps bouncing off that level, so we'll draw that in. So as we go across, we just keep graphing it up, and we end up seeing patterns that start to create. Now I'll keep going forward to show you something that's fairly interesting. So we come down, and as we fall lower and lower, you can see this trend line, these 2 points of data that occur. At the same time, you can see this shape of where it went straight up and then kind of hit some unexplained level. There was resistance from back here, a smart money sell zone. So this would have indicated a good potential short right there on October 21st, or previously, in fact, on October 15th. So now we actually have that strong, aggressive level I was talking to you about before. So, does anyone notice anything else about this pattern here on the right-hand side? Anyone notice what type of pattern that could be? What do we get when we see a channel? Yeah, so Gabriella, when we see a channel that has this big bulb going through the middle of it, that's right, head and shoulders. So immediately, some people ask me, how do you predict a reversal before it's already happened? Well, we draw out our head and shoulders channel here. And now I'm going to anticipate, I'm going to assume that we're going to run right into resistance around this 32 area because we can see this is possibly a head and shoulders, or at least, very least, a channel. So we get a great short down to here, a rally up, we hit resistance. I'd be getting in at 28 and out at $30.50. We pick up another 10% and down. We hit the resistance. I'll just extend this line. We hit resistance and we fall. I'll extend the support as well. We hit support and we rally. We hit resistance and we fall. We hit support. We've caught horizontal for a bit. We break. This is actually a descending triangle. You can see here, lower tops, equal bottoms. And we fall. So that's a bearish pattern. Lower highs, equal bottoms, that's a descending triangle, and it drops as it should. That's where and now we're at support one more time. We rally again. We hit resistance. So we've got a consecutively good series of trades here that we've been able to know what relevant lines would be by having projected them from earlier in the year. Okay, now as we move forward, what do you see there? Do you see here how we have broken this downward channel has now been broken there? So as soon as we see it break, we now know to look for a new pattern. And what pattern do you start to see? Another head and shoulders. Thank you, Bruce. Exactly. We start to see that nice little shoulder here, a head, and a breakdown. And then this was something that we actually picked for a trade 2 weeks ago. And you can see as it pulls down from below 27, it starts to drop. Now, knowing what we know about picking smart money zones, we now need to know a target of where we would expect it to drop to. How to pick an entry is as soon as it broke below here, around 27. A target was to look for exactly where the smart money had bought this before. Where was that strong, aggressive zone that we would not want to challenge? And we look back and see that this right here at 24 was a very strong, aggressive bounce point. And that therefore becomes our target from 27 down to 24. So we get about a 10% potential profit, 70% plus potential on the options. And we go forward, and we hit that on the nub right there on Friday. And if you go to the hourly chart, so this would be where you take profit. This would also potentially be now where we could go long. And straight up, have a look at that. I'll just go to the hourly chart. You can see this beautiful kind of pattern played out. Right on the mark. Look at that. So there's your head and shoulders. There's your head. And there's your target. And look at the target. Perfectly on the same level, you've got that strong... Pablo, yes it was. That was on the live, yes. So there's Zoom. Now, so that's how we start doing the trend lines. So yes, for a swing trade, we want to go out 6 months. That's right. So now this is a great example of how we actually illustrate the trend lines. Okay? And now we're off into new territory. Now let's start to implement other factors. Let's start to look at other factors. Let's look at another recent pick we did on Capital One. Now, going to go back to the daily chart. If there's any stocks, by the way, you want me to have a look at, we've got about 8 minutes, 9 minutes by the looks of it left. I'm happy to bring up some that you'd like me to look at. Let's go to Capital One. Now, when I looked at Capital One, here we go. Zoom was something that we had a target on just below 27 because of that shoulder, as you can see here. You see that? So there's our peak. So we've rallied right up into that peak. So that would have been the target here for where that right shoulder would create itself. So you get that lovely little pop, and that's straight up into the target. All right, so let's look at the emerging markets, for example. And this is where I'm going to show you the smart money. Yes, absolutely, Charles. Definitely look at the weekly chart. In fact, that's how we picked our head and shoulders on Apple back in October 2012, from 680 all the way down to 400. Perfect head and shoulders. Okay, so here's another example. So you start to build in your ideas. So you start to say, well, the emerging markets are looking pretty terrible. So you go to your world indexes, you look at something like the Hang Seng, and you can see that when you look at things like the Hang Seng, I look at things like money flow, and we can see a really diverging money flow. The market's just really looking at a downward trend here. Of course, there were bigger problems. Got a potential head and shoulders here again. So you go into okay, well, what type of stocks have exposure in the emerging markets? And you can filter for this. And here was Joy Manufacturing. So again, let's look. We've got a fundamental reason why we like it as a short. A fundamental reason why that the emerging markets were weak. So we can see up, down, up, sharp sell-offs, sharp sell-offs. We came up and we hit a third time. That's the last time we consider a trade. Went straight into resistance. So here was your number one signal of what we discussed earlier at a strong, sharp reversal area. So that was on all of our criteria we've discussed earlier today. It met that criteria. Then we start to see that the fundamentals of joy manufacturing is very much exposed to emerging markets, and next thing. So in a weak market and a weak sector. So it was a pick for a short here, and then you can see it rallied back up and then created a second peak. And as we start to look at that once more, what do we get? A descending triangle. Lower highs equal lows. So this was actually a something we picked as a short here at $57, and also a short if it broke 55. And as you can see, nice big drop straight down to the next level of support. Again, trading with targets. You ask about the cup and handle formation. This is why the reason I would not have considered that is because this was an oscillating trade. It was moving in an oscillating way. And finally, if we look at that smart money again, this is an indicator down the bottom, money flow, chalk and money flow is similar, where it will look, is the stock closing with higher highs and higher lows with volume and at the top of its range or not? So the next key thing that I want you to take away with today, and there's a lot I could talk for hours, but then one key thing I want you to be able to take away with is to see how that then adds your final step point in your analysis. As the stock made, this line tells us, is the smart money interested or not? And as you can see here, as the stock continued to make equal highs, so price was the same, money flow was not. And what do we call that, folks? We call that divergence. So the final kind of tick to this stock's boxes was that it actually hit lower highs in the smart money flow. And I prefer that, Charles, because it looks at price and the closing, its position in its range, as well as volume. And that those three things is what truly tells you market sentiment. So this was a perfect short candidate. If you want to look at other ones, just another example, COF, Capital One. Descending triangle. Money flow dropping out of the sky. This is one we picked for a short. We picked that as an option play for $75 puts. Those went up 350% or so over about 2 days. You could look at, there's a bunch of these types of things. Let's have a quick look. How can you tell when smart money anticipates earnings announcements? Well, we may run out of time for that. I'll try my best. The smart money always generally shows what's going to be predicted. I've seen a lot of questions about Facebook, so I'll bring that up as an example. Have a look at this. Again, you're going back long enough. I've actually drawn that a little bit too high. So you can see here, if you actually connect the lines on Facebook ahead of its announcement, you'll see that Facebook bounced back and forth between its channel for the longest time. So we knew Facebook was in a down channel. Facebook was coming up to earnings announcements, and we needed a way to know which way that was going, and the smart money generally does. And here you can see, like I told you before, that is where the trend is broken. Now we want to be looking at a new trend. And what do we see the smart money do? As of that day, it breaks back above zero. So as price is decreasing, Smart money is buying. This is divergence in the opposite direction. And you could have predicted this big movement. I can show you example after example. Here's the final one, BlackBerry. Same thing. Price going sideways, but despite price going sideways, money flow continues to drop. And this is also how you could have detected that type of earnings announcement. So I'll go over to the questions quickly. Well, we've got about a minute left. Let's have a look at Apple. So Apple, look at this. Apple making new highs. New highs. Money flow does not. Smart money selling. Double top. Perfect opportunity for a short. Drops down from 570 down to 540. Actually, this is actually one of the ones we talked about in our last event with Morgan, I believe, and we talked about this being a perfect short right around here. Pop down. What's money flow doing at the moment? We're consolidating. Looks like it's going to go for a break. So the key takeaway as we finish here is to look for your trend lines, follow the rules, and use your smart money to tell you the strength of conviction in the sentiment.